Um, Today I will try to wrap up the ongoing session, and I'll take up two more sessions. That is securities in lending and also the credit control mechanism. And to my knowledge, I could not cover this part of the session. That is credit risk mitigation techniques and the credit cultures. Right. Credit risk is there always, and I am just proposing some of the practical aspects of credit risk mitigation rather than models and theories, because risk happens in two ways: pre-disbursement and post-disbursement. Ideally, it happens post-disbursement, but in order to avoid any issues once the loan is disbursed, ideally we should ensure the loan is properly disbursed before you disperse it, so that there are certain things that we can take up. So some of the things already we have discussed. The number one is industry analysis. That means before the client, but we should look at the industry. Like during the past 1.5 years, we were not concentrating on tourism industry, because everyone knew the tourism is quite risky because there was no cash flow. So that there was an industry risk in it. While the other some of the industries were picking up like nothing: retail, um, health industry, and food and beverage, IT primarily, and these industries were picking up. So before the client, you should look at what the industry is and what is the richness of industry. So for this, of course, we discussed one of the models, that is Michael Porter's 5 forces. We also can look at the value chain analysis, in the sense this is more I would say supply chain analysis and value creation analysis. Now, if you take industry like dairy, there's a value chain. What is that value chain? Starting from farmer, and then it goes to the collector, retailer, processor, likewise. So that value chain, what are the issues in the value chain? There are points in it, of course. Whether there are any issues in the value chain and in which point that the bank is going to finance it. So it is nothing to do with the particular client, but the whole set of the environment. So that this is not the particular value chain analysis introduced by Michael Porter. Here the industry value chain. Okay. Then the next one is the one that we were discussing in the first 4 days or 5 days. Credit appraisal. How best that we appraise it. Now, we need to appraise the credit based on the cash flows. As you know, the SLRS, or the number 13 of 2021, the central bank credit rather NPL classification and impairment guidelines, is comprehensively based on the premise of cash flows. And in now, from this 1st of January, we can't do the NPL classification based on the securities, and you can't do the impairment based on the securities, but only based on the cash flows. Okay, now now NPLs are classified into 3 stages. Stage 1 Stage 2, and Stage 3. Stage 1 is underperforming, Stage 2 is underperforming, Stage 3 is non-performing. So all that happens simply based on the cash flow. So given that, we should be able to analyze any underwriting or any credit appraisal based on the cash flows. Whether it is retail, yes, it is also based on the cash flows, the salary. And then business, obviously based on the cash flows. And credit approval need to be in a comprehensive methodology, because you should not give every credit approval to the lower level, depending on the risks and also the amount. There is a hierarchy of credit approval in any bank. And I know in some banks, even in some large banks, credit approving authority has been centralized, not decentralized. Some of the managers are not having any credit approval authority, in certain banks, but in my bank, of course, the branch manager has a large amount of approving authority, because when it comes to my bank, we are a large bank, and you can't have a concentrated one credit approving authority, because that will be uh, overloaded. More ticket sizes are across the country, so that the branch managers have been given the DA. Then the next one, before it goes to NPL, ideally, if you can structure the limits, excellent, because this is what is lacking in most of the bank managers and credit officers. Once we diagnose, so credit underwriting is about diagnosis the problem. It's almost like the doctors, they call for reports and various other information. Based on that, you need to decide what is the cause of medication. Like in medical doctors, financial doctors, of course, we need to develop the facility based on the need, whether it is investment or working capital. As we discussed over the last few weeks, as you know, that the determining the exact amount for working capital is a very, very crucial challenge, and it has not been practiced properly in our country as well as in other countries, so that always we go by the accountant's definitions of working capital, which is not true. Okay, a practical sense of working capital calculation has been discussed with you. And also better we can decide the tenors based on the cash flows. Some project lending need to be long term, but working capital obviously has to be short term. Unfortunately, in Sri Lanka, as you know, that we don't have development banks for commercial lending. We are only commercial bank for development lending. So that we always try our level best to bring down the tenure less than 10 years. But in case of large projects, of course, ideally the bank should be able to extend the repayment period over 10 years even. So, because you can't expect a high acceleration from the projects which are new to the industry. It will take time. Because of that, we should be able to give a breathing space for projects to pick up the cash flows. But unfortunately, it doesn't happen here in Sri Lanka. And then disbursement plan. You can't just overnight disperse a loan. I mean that the whole lot of money should not be dispersed at once. It should be split into some stages and see what the contribution of the client, whether the client is able to contribute to the project, so that the bank, and thereby it is a combination of bank and the client. And also we don't give it at once, because we want to see the progress gradually. Based upon a gradual progress, only the bank can release the money. The intention is to also avoid risks of getting the project into failure, because there are chances that the funds will be misused by the clients, especially with regard to a client who is doing a lot of projects. He will divert this funding to various other projects. So if any other projects fail, and the entire cash flow cycle will fail. And further, we can go into covenants. There are two types of covenants, negative and positive. You can come up with positive covenants like you should do these things. You should maintain financial leverage as such, debt equity ratio as such, and the current ratio are like this. You should provide the financial statement every 3 months, and the director should not leave the company unless the loan is settled. And also various other covenants. Negative, and you should not borrow from other banks without the concurrence of the bank, because there are chances that the financial leverage or the debt equity ratio might get affected as a result of excessive borrowings. But it happens, it happens. I want to add one thing very important, that never mind having either positive or negative covenants as much as possible, but there should be a body to follow it up. Under credit control mechanism, I'll tell you, there should be some responsible parties who should follow up the covenants. I know there are in other international banks, of course, there are the outsourced companies who is following up the covenants, whether the registration fees, insurance have been renewed, or those things also part of the covenant, whether the particular assets have been insured. You know, in Sri Lanka, it is one of the issues. Particularly, the mid-sized customers are reluctant to insure because one of the covenants of the bank is to ensure the building, the land building and machineries and the stocks need to be insured. What they argue is, what they say is, given that we have given you a positive, very valuable security, why should we? It's not the case. You guys should be able to understand the customer, educate the customer the need of insurance. And also, you have to be very careful with the insurance fellows because more than the inclusion, they have enough exclusion list. There are enough exclusion list of exclusions. So if this happens, only this will happen. Likewise, I mean that you have to be very careful because the guys who are promoting the insurance are reluctant to say what the exclusion is all about. Okay, please negotiate with the insurance people and whether at the time of claiming the insurance only all these negative things or the exclusion list will come up and say no, we can't claim, meet the claim. Okay, likewise. And especially with regard to project financing, during the construction period, get a erection policy so that if there is any accident, any failure, should be able to cover it up. And sometimes you ask for mortgage protection insurance because if elderly people are part of the clients, better you ask for a mortgage protection insurance, which is quite expensive, but can't help. Perhaps the customer may like it, may agree with that because we have understanding typically over about 60 years. Of course, we believe they are elderly people. And one way of mitigating that risk is to get some more younger people on the board or partners and get them also to be responsible for the loans, or else you get some mortgage protection insurance. We call that loan protection insurance. And then the other key thing is buyer supply contracts. If I tell you a simple example, if you want to convert your roof into solar power, there's a buyer agreement. That's called the off-take agreement. Okay, buyer's agreement is called as the off-take agreement. Buyer is the one and only single buyer in Sri Lanka for electricity is the Electricity Board of LEPO. So they have an agreement. Now that particular agreement they signed for 20 years. The first 7 years they will pay us 22 rupees per unit. Thereafter 15 rupees per unit. So that's guaranteed for a period of 20 years. To my knowledge, so far they haven't defaulted, but there is a delay of payment, 2 months delay, but still they pay it. That's good. Likewise, you can now recently a new loan scheme came up from Ministry of Finance to promote organic fertilizer. The rates are like it's an interest subsidy scheme where the rates are like up to 10 million, I think 2% for the customer, 10 to 1 million, I think 10 to 10 million. Yeah, 1 to 10 million, I think 3%, even up to 1 billion, only 4%. But the yield for the bank is roughly about 8%. In it, one of the condition is if the customer wants to borrow at those such concessional rates, they need to get a buyback agreement with the fertilizer companies. There are 2 fertilizer companies, so Land Reclamation Commission plus the T-Board also buy. Whether you are supplying to, whether the client is going to supply to T-Board or the fertilizer companies, they need to get into a buyback agreement so that we have a guarantee or a warranty or an assurance. I won't say it is a guarantee. There is a particular buyer who is going to continuously buy. But then again, it is not a guarantee as such. It is just a kind of a comfort that there is a it's a forward rate agreement like. Okay, there's a particular buyer who is ready to buy the stuff. So the market risk is eliminated as a result of that kind of a buyer-supplier contracts. And suppliers also may getting into contracts to supply certain amount of goods for a continuous period of time. Then you can go for securities, which I will discuss later on, and then the portfolio management. You see that it's not a secret that in order to mitigate the concentration risks, that state banks are reluctant to supply, or rather, state banks are reluctant to finance the oil bill. One reason is that hardly any foreign currencies. The second reason is that the concentration risk. So that recently central bank allowed all the private bank also to finance the oil bills, so that in time to come, the what I feel is, it's not a quote from me or statement. CPC account is liberalized. Even the private banks can enjoy the state accounts. Okay, that is because it has been a warning coming from Central Bank of Sri Lanka for these two state banks, just to bring down the concentration. That's good, so that in case of any failure of CPC, it's not going to be a failure, by the way. The intention is that you should not concentrate on one or two organizations, because even if you just look at the single borough exposure to the CPC and CEB, quite high. Okay, so the bank should be able to mitigate the risk. So before we grant, we have we have looked at the concentration risk and made a warning to the CPC, so that the CPC would have requested the Central Bank of Sri Lanka to get them to deal with the private banks, so that the private bank also can come into the risk mitigation along with the state banks. Hopefully that you understand. It is not a statement given by me, but that's a sort of understanding according to the market behaviors. So these things can be done before it dispersed, before the loan is granted, and ideally these are the more valuable precautions, because once it is gone, of course it is gone. Then you have to look at how best that we can look after this. Once it is granted, thereafter it's a matter of management. You know that the highest ever risk that you undertook in your life is marriage. Getting married to a partner who is known, whether you are a male or a female, both have similar risk parameters when it comes to relationship. Okay, so once it is done, of course, in our context, according to our cultural and traditional acceptance, you can't just divorce a partner. You can. Recently, of course, I could see divorce rate has been increased, but ideally what you should try to do is to manage it. So even in banking also, what is important? Relationship management, very, very important. And, we recently did a survey for us for mid-sized markets. In it also, it was revealed the couple of things that the customer wants is, one, the product awareness. What do banks sell us? And if you go to a branch manager today, traditionally what they say is the same across the banking industry. Even if you go to bank A, bank B, bank C, they might probably tell you the same products that they have, or only a little bit of a name difference. But if you just look at the features of the product and the type of product, same. But you know, in banks there are bundles of products which are not properly communicated to the customer. Number one. Number two, a very close relationship, because you know that this relationship management, I think I discussed when I was doing credit marketing. You can put everybody into a triangle and divide the whole set of customers based on some of the parameters. One parameter is that profitability and the volume of loans. So certain amount of large loans can be handled by the branch manager as a relationship manager, and the next level of customers can be handled by the credit officer. And large amount of clients whose ticket sizes are very small. When I say large amount of customers who are the retail customers should not be handled very closely. You can't do it, of course. You can't do it, and their profitability also quite low, so that you can handle them with the management information system, or from the reports you can look at the progress of repayment. Whereas large ticket sizes, where there is a bundle of credit package, bundle of credit facilities granted to one single customer, may have a lot of queries, lot of information, lot of requirements, especially a customer who is having a what do you call trade line, trade facility. So you have single ticket sizes, so that everything has to be monitored. For those customers, you need a relationship manager who is dedicated. And monitor the performance of the clients, follow-ups, which I will take up later on, how to follow up them. And then the strategic restructuring. Ideally, strategic restructuring has to happen from the customer. Customer should do the strategic restructuring. In Sinhala, you call that upayashili prativhyuha karane. Now, there are a couple of things that you can advise the customer. When the customer is struggling to pay, that is simply because there are management issues. So number one that you can tell them is come up with a business plan. So they need to develop a business plan from now on to the rest of the other 3 years at least, so that they will come up with new strategies. Okay, in it, one of the things may be retrenchment. Retrenchment is all about pruning the products. So stopping some of the productions simply because they are not giving the company a rich cash flow. Okay, so you better stop those things rather than continuing. And the customer also can do the outsourcing some of the operations, so that you can do a value chain analysis, as Michael Porter said. Look at inputs, performance, processes, output, and after sales. Even in each under each every element, of course, you could see plus minus things that are happening. Some of the things you can't, or rather you don't have to do in house. You can give someone else to do it. Like if I take an example, Lever Brothers. They won't tell you, but actual stories that Lever Brothers, the most fast-moving item is sunlight. They don't manufacture entire production within the house of Lever Brothers. Rather, they manufacture the core product, which is almost coming like a chip, which is given to the other manufacturers who do the subcontracting for Lever Brothers. So unless otherwise, Lever Brothers may need to develop a big factory and do it. Even recently, Nestle has ventured into milk, coconut milk production, which is going to be very much healthy, because they truly understood the cash flows of the fresh milk is going to have an impact, because as you can see, now there's a scarcity of milk powder in the market. Sorry, we could see only the fresh milk, and they could have seen it earlier on, so that they have diverted, which is a related diversification to the coconut milk production. Now, even coconut milk production, they don't have, they have a plant, of course, but what they ideally do is they get subcontract clients who manufacture the basic coconut milk, because it takes such a long process. Like we have to bring down the coconut nuts and remove the hard part of it and do the kerneling and impairing, and then convert them to BC, and thereafter do the milling part of it and take that and maintain the quality levels and give it. So that's a huge process. So that better you give it to somebody else. And there are enough clients who are supplying milk, coconut milk to the Nestle. They are not in bad, but that is one of the ways that you can do it. Otherwise, what you can do is you can divest. One of the thing is retrenchment. The second one, outsourcing. The third one is divest. Divest is selling part of the business. Even with the Michael Porter's value chain analysis, if you feel that there are certain elements, certain production processes, which you should not do, give it to somebody else. Okay, by selling the entire production line. By selling so, it doesn't mean that you are going to disturb the production lines of the company right now. Rather, you try to give it part of the production line to somebody else, so that and all this, that is one divestiture. And then again, the other one is uh, restructuring the entire organization with a kind of management and everything. Sometimes, you know, what has happened is in organizations, there are people who are really doing sabotage and various other misconducts to bring down the operations of the company. One reason may be that they don't understand the gravity of holistic approach of the company, but second reason may be that somebody is behind them. So that is why you could see them continuous strikes are going on in certain companies. So then you can divest and restructure the entire organization. Probably you can send some of the people out with voluntary retirement schemes and get new ones with an agreement and a commitment. Okay. And otherwise, you can liquidate. Liquidation is selling the business and get some cash. The intention of the strategic restructuring is to ensure that there is a consolidated cash flow, improvement of the cash flow. One thing that you need cash to repay, settle the debts which are overdue right now, and also you need cash to expand the operations. So the strategic restructuring, the ideal focus has to be to improve the cash flows. And the financial restructuring has to happen from the bank side of financial institution. As you know, you can restructure the loans, you can reschedule the loans, and the newest initiative is rehabilitation. Restructuring is about performing loans. The condition is that you should have only 2 installments arrears, and it should be in the performing category, so that you can extend the repayment period by another couple of months depending on the cash flows. But remember, restructuring can be allowed only when the customer is in trouble, and the reasons for which is beyond his control. Okay, probably the macroeconomic issues and all. And the next one is rescheduling is only for NPLs. Once it is the same agreement, but you have a different terminology because it is non-performing. Restructuring happens, and if it happens 2 times, you have to put that particular client into the second stage, which is underperforming. Rehabilitation, if I before that, of course, you can add one more thing, which is not a moratorium, debt moratorium. You can enjoy debt moratoriums as instructed by the Central Bank of Sri Lanka. Remember, if a debt moratorium need to be extended to the customer, because of the macroeconomic fundamentals, that has to come from the Central Bank Sri Lanka as a circular. The Central Bank Sri Lanka also will issue the circular based on the concurrence of the CA Sri Lanka here in Sri Lanka. Okay. Rehabilitation is quite different from both the above. Under rehabilitation, of course, you can take a performing loan and do the restructuring. But if it is a non-performing loan, you can do the reschedulement while giving fresh facilities. Mostly, they are working capital financing to revive the business with working capital financing, and then gradually to pay off the rescheduled and restructured loans. And the rehabilitation cannot be extended for customers who are willful defaulters. Frankly, that's not possible. Now, I myself, in my bank as well as the Bank of Sri Lanka, what I heard is that there are units called rehabilitation unit, and we also have done a sizable amount of projects, and we issued the guidelines also. And so far, I don't think any of the banks have issued proper guidelines for rehabilitation. Everybody lacking in our country rehabilitation guidelines. What happens is rehabilitation, you might either restructure, reschedule, and plus giving some fresh facilities also to ensure the loan is properly rehabilitated, and very importantly, what you want is the follow-up. The other three are basically the last options, like realization of collateral, that you get the customer to sell it or you auction the property, and then you go for legal actions in case hardly any properties, okay, which I'm not going to discuss over here. The last one, of course, you can discuss composite settlement. Composite settlement is something that you come to an agreement to accept low amount of money instead of a large amount of money. Right? If I put them into numbers, let's say there's a loan of 10 million which is in NPL, interest arrears is about 8 million. That is what happens. Sometimes the interest becomes larger than the loan granted over the period of time. So let's say 18 million outstanding plus that is capital plus the interest. And you have taken every effort to recover these loans but fail. So that what you are proposing is to customer to come up with a small amount of money so that we will agree. So that you have to come up with a proposal and convince the board of directors and agree to a proposal to forego part of the interest. And the customer may happy, for which instead of paying a large amount of money, why not try undertake to pay a small amount of money so that the story will be closed. Not like NPL loans, it is gone out of the book so that it's eliminated from the system. Right. Give me 2 minutes because I'll be taking a few minutes of break so that to sharpen the sword. So that will be ideal, effective. I'm not going to close anything. So 2 minutes, okay. Right. Let's try to see the credit cultures in banks. There are basically 3 types of cultures, but before that, what's a culture? Generally, management credit philosophy, culture is a set of values, behaviors, philosophies, and norms. Forget about credit cultures. The culture is a set of values, norms, behaviors, a thinking pattern, assumptions, and partly artifacts. Artifacts, the tangible things that you can see in an organization. See that culture is a reflection of the thinking pattern of the top management and the set of organizational top people or top people. Now, if I tell you an example, you know the culture of government-oriented organizations. If you go to Inland Revenue, I can see they run to the uh, organization by 8:30, 9, I think. Thereafter, from 4 o'clock, you can see the people are going out. So imagine that how many hours that they have to work. Of course, that's the part of culture. Like their intention is to run to the train or bus immediately. But in private sector, you can't do it. Even if you take a bank, of course, sometimes when you leave the bank, it's about 6 in the evening, 7 in the evening. You have to close the whole transactions and go. Okay, so remember the culture is very important for the performance. The entire performance will depend upon the cultures. And if someone wants to change the culture, it's up to the top management basically. I know that this president want to ensure the effectiveness of the government sector organizations. And one of the strategies to do so is making the processes digitized. Recently, there was APB conference, annual 32nd conference. In it, of course, there was a case study coming from Sri Lanka Customs. And as for the deputy director or director general of that customs, he explained very clearly how they have digitized online the procedures of customs. Customs is a very crucial place. You know that it's a earning place for the government, and also We have heard of taking bribes and everything in customs. So those are some of the stories. I don't know how it happens once it is digitized. Okay. Likewise, the president intention is to ensure the government sector is more effective than the private sector. So one of the strategies is digitizing, and government has very clearly said in this year that no government jobs. So they will limit the people who are working in the government sector because too much of employees are employed in government organizations. One classical example is that if you take Sri Lanka Broadcasting Corporation, from the chairman himself says the SLBC had cost about 1,083 people. You clueless, no? 1,083 people for SLBC. How many channels? Like, I mean, that they have about 4 or 5 channels to run a broadcasting corporation. It's not a TV channel, at least. There you have to carry cameras and do some televising and all stuff that just recording. 1,083 people. Because what has happened is repeatedly the government have been putting people there without thinking the effectiveness of the organization. So that imagine that large number of people are not working in it. Ideally, you can imagine. You don't have to go and see that. So that's a culture, but they need to be paid. He says, the chairman says, and he has to get money from the treasury, at least 25 million. I think 25 million. Yeah, every month from the treasury. So it is not an earning organization, which has to be a commercial organization, by the way, though it is the state broadcasting corporation. Either you have to. So this is the problem, cultures. In credit, the management credit philosophy කියලා කියන්නේ හිතන විදිය philosophy on a rational basis or whatever it is, determines how much risks the bank will take and in what form. So credit cultures are basically risk related. A bank's credit culture refers to the fundamental principles that drive lending activity and how management analyzes risks. So one way that you have to see the credit portfolios are increased at the level of risks. Of course, without thinking even you can increase the portfolios. You can increase your portfolio like nothing. There are enough customers who would like to borrow, but you know that how many customers are coming out, how many proposals have been turned down, because we understand the level of risk appetite that we have in our bank, because we have a credit policy. So there can be large differences between banks and their lending policy. Even if you take finance companies, you can see some of the NPL ratios are alarming, and their interest margin also very high. Whereas in banks, NIM, net interest margin, is quite low, so that we don't take that much of risk. We are very conservative. So based upon that, there can be 3 different cultures: value driven, current profit driven, and market share driven. If you just look at the value driven, it is the most recommended culture which should be prevail in an organization. Focus is credit quality with a strong credit management system and controls. The primary credit emphasizes bank soundness and stability. So the bank wants to stabilize and remain very solid for a stable period of time. Okay. Underwriting is very conservative and significant loan concentrations are not allowed. Typically outcome is lower current profit. So these companies, these banks have a gradual growth rather than a very strategic growth. What is the difference between a gradual growth and a strategic growth? Strategic growth happens very fast because of the strategy. So one of the strategies may be taking high amount of risks, but this value-driven cultures doesn't make any big risk. Of course, it doesn't mean that they don't take risk. They do take risk, but most probably they will undertake the risk upon the calculation of it. So they have a mechanism of risk calculation which is part of the credit policy and underwriting principles. So these companies are highly that rational or principle based companies. Current profit driven is basically focuses the prevailing current profit share. Short term earnings are very much given the priority, so the management is often attracted to high tech. They encourage the credit officers to go after high risk borrowers, And as long as the economy and the macroeconomic fundamentals are good, they can enjoy the beauty of it. But provided that in a period like pandemic, what has happened is they might have to incur a loss. Similarly, you get the market share driven. Their intention is to enlarge the market size by attracting more and more risk-based customers. Okay, and sometimes since their underwriting mechanism is quite aggressive and take high amount of risk, so they can be in trouble when the market presence is not good. When the market is high risk, so they have to take that risk.
So can I interrupt you?
Yeah. Why not?
So can you kindly tell me what do you mean by underwriting?
Yeah, it is nothing. Underwriting is another word for credit appraisal or credit evaluation. So in typical textbooks, for the purpose of credit evaluation, what they say is credit underwriting. There is nothing much. It is another word. That's it.
All right, so thank you very much.
Right. Any other questions? I like questions because otherwise I also feel sleepy. So, right. We have 2 more sessions. Before securities, I will take up the credit administration and follow-up. It's a very short presentation because that is also part of the credit process. There are 2 things here, admin and follow-up, because you know that the process of underwriting is starting from credit marketing. If I say underwriting or credit evaluation, start from credit marketing. And you attract the customer and issue the application and do the evaluation and analysis. Primarily you do the analysis and then do the evaluation, and you determine the DSCR or ISCR, and then you take securities, and thereafter you do the security evaluation, and you present a paper to the credit authority, and the paper would be approved. Immediately after the approval, what you need to do is to propose the credit offer to the customer. So it's some banks it says condition letter. Most of the banks says it is an offer letter. So once the offer letter issued, the customer has a choice to accept or reject it. Sometimes they decline it and say that I don't agree with some of the conditions. So then you have to work it out again if you do agree with the customer, because even I have done it in some couple of cases. Because in an offer, what happens is it is not the original proposal that the customer was intended, but we may cut it down, chop it down, and then again we may come up with some other adverse conditions even, for which the customer may not like. So that he will have a counter argument, for which of course we can accommodate back again. But only thing is, you have to represent the proposal with some amendments to the same approving authority. Let's say that they agree with that, and then you have to get the customer to sign the offer letter. Offer letter is very important. And then from there on, it has to be handed over to the credit administration department. It is not the credit evaluator who did the credit evaluation, because credit evaluator or the branch manager is in favor of the customer in most of the cases. And remember, the credit admin people and the credit risk people are totally independent people. There is a huge duty for credit admin people to ensure the documentation part. Okay. So there is a copy of final approval along with the offer letter need to be handed over to the credit administration department to finalize the documentation part of it. What are the important things? Check the approved credit memorandum or other credit proposal and the security list of securities. Because along with the credit memorandum, there is a security checklist. The documents or the securities need to be obtained for the particular proposal. So you have to obtain the security documents, all the required documents, not only security documents, loan documents, general documents, and the security documents. Then you have to get ready with the security documents, and thereafter you have to perfect them. What do you mean by perfecting? There are certain other parties with them you have to either notify or get it approved or register. If you take land registry, you have to register the documents with the land registry to get the higher priority. And if it is to something to do with the vehicles, RMB, and if it is a loan to the company, loan to a limited liability company, you may have to notify the register of companies, because you know that to get the priority in case of liquidation, unless you have registered with the register of companies, you don't get the creditors rights. You can't get your name as listed in the creditors list, but remember, if it is a mortgage, you have the priority. Then once the security documents are perfect, in the sense getting signatures from the customer, loan documents, and then for notifying or registers with the other parties, and then you have to take an approval for the credit file. What does that mean? It is not the credit approval, but the security approval, security documents approval. Somebody has to approve. What do they approve? They approve the obtained documents are in line with the checklist of security documents approved by the hierarchy. So then you have a perfect credit file, and the admin department themselves need to disperse the loan according to the disbursement plan, which is partly in the credit memorandum. So you can see this part of job is independent from the credit underwriters. So underwriters have no say on credit disbursement. And thereafter you need to recover the levies, like by the time.
Hello, sir.
Yes.
There's a small question to ask, sir. Now this documentation part. Now, if say if I am the approving authority, what is the accountability we have for the perfect documentation? Or it is lies with credit admin or the people who are disbursing the facility?
Okay, I was supposed to explain you, because I know in some banks, when it comes to small loans, what happens is admin department and credit underwriting department are the same people. Like 100,000, 500,000, maybe 1 million even, I don't know. It all depends on the threshold of the number of loans that are in the bank. In my bank also mostly same, yes. Some of the loans are disbursed, approved and disbursed at the branch level, so that they are responsible for everything. But only thing, once the loan is disbursed, you can't keep the documents in the branch. You have to put it into a kind of a safe custody. Ideally, it has to be in a central location. You can have the copy documents, or vice versa. I don't know. You can have the documents in your custody as well. But as for the Basel III requirement, you can't have it in yours. Like, I mean, that it has to be a separate department, independent department, who does the elements of or other functions of credit administration department. So what happens is, ideally, if you look at these two functions are separate functions, and there are a lot of fights between the credit evaluators or the manager and the people who are doing the marketing and credit promoters and the credit administrator. Credit administrator is a very bureaucratic function. He doesn't mind whether you have the customer or not. Of course, what they want is to complete the documentation part and disburse the loan. So there is a responsibility for the credit administration people to ensure, number one, to obtain the documents as per the credit memorandum. Okay, all the documents. If the approved limit says you have to take this covenant and that covenant and everything has to be completed. Then number two, disburse according to the credit approved limit paper. And thereafter, recovery of levies, insurance, maybe all the other inspection charges, stationery charges, okay, all that has to be recovered. And also do the valuation and stock inspections periodically to ensure the covenants are complied. But and also renewal of insurance and licenses, reviewing the credit limit is going back to the credit department, not the administrator. And reporting happens from both parties. So over and by and large, the credit administration department is a separate department which is independent, and then responsible for their job. It is their job is not to approve the credit, but to ensure the documentation. But remember, end of the day, if you say the credit is an asset, asset is reflected through a proper set of files, documents. Because one day, if the recoveries department, if the loan is defaulted, probably this loan will be transferred to the recoveries department. So recoveries department will take the documentation from the credit administration people. So if there is a no order in the credit file, then for which it is not the recovery department, it is the credit administration department who is responsible. To answer your question, some loans may be that you do everything. You do the credit promotion, credit evaluation, credit approval, credit administration, and follow-up, especially at the branch level. But ideally, it has to be a central department who does it. Okay. And recently, on top of everything, there is another department as per the central bank guidelines, which is the credit review department. Their job is to ensure once the loan is disbursed and done everything, they don't handle the credit administration part. They take samples of credit and do a review of all from the beginning, like whether the loan has been evaluated properly, whether the loan has been disbursed properly, whether the credit administration people have done the job properly. So they will report to a credit evaluation. I think there is a committee, a subcommittee, board subcommittee. No, it is an executive committee, credit risk review committee. That particular department is responsible for that particular committee, and in it, some of the weak points and the loose points and the malpractices or the misconducts can be discussed, and some of the cases may be reported to the audit even. So the audit can come up and do a thorough evaluation and punish the people who are responsible. Okay.
Yes.
And if you just look at what these documents are, there are legal documents. Okay, legal documents basically related to mortgages and something like that. And then again, credit documents, credit application, credit agreement, offer letter, things like that. And also security documents are there, flow notes, receipt, mortgage bonds, guarantee bonds, trust receipts, pledge note, all that stuff. And general documents like the inspection reports, registrations, approvals, licenses, building plans, things like that. Important, what is important, all documents should be in order. There should be no errors at all, because the thing is, end of the day, if you consider this loan is an asset, and the set of documents are the asset, and these documents should be duly signed. There can't be any mistakes. Especially, you can't have text phrases and everything, because at the end of the day, if you are trying to sue the customer in courts based on the documents, if your documents are not in order, and that can be challenged by the other party. So you have to be very careful when you take the documents, they are in order and witnessed by the relevant officers. And there is a question here also, who should be the witnesses? Witnesses should be the bank officers, ideally, not anybody else, because then the signature cannot be challenged. So if somebody has signed, so that is in front of the bank officers. If you look at the location, ideally it has to be the bank location, so that there can't be any issues. But I know in certain cases, like corporate customers, they don't like to come to the bank. But in case even the legal officers and the relevant officers will go to the customer and get the signatures, and you have to ensure the place is properly identified. And there is another case where when the customer is away from the country, and they have to sign it, but they can't sign and send the documents, because who is going to witness it? So ideally, it has to be witnessed in embassy office, whose witnesses can be accepted. Some legal officers may accept it, or else, because the problem is the witness location is not within our jurisdiction, so that there can be complications. So that you have to refer to the legal officer, and with their concurrence only that you can accept it when the customer is away from the country. But ideally, you better ask the customer to come here, and that is why we have seen that when the customer is about to leave the country, they hurry it up and try to finish the loan documents and get the signature and leave the customer. That would be ideal. Try to get it signed in country so that the signatures are within the local jurisdiction, so that easily we can put the case into the courts. Otherwise, your documents will be challenged, because when there is a dispute, they try to find fault with the bank, and even they know where they sign the documents, right? Right. All the other conditions and everything. Yes.
Sir, what is the correct priority order for this letter of offer and the mortgage bond for the first-time customers? What should sign first, the offer or the mortgage, or if you can sign
Immediately after the approval, you have to get the offer letter signed. Okay.
then thereafter only you can get the mortgage
That's
signed.
right.
Okay?
Offer letter means that they haven't got the loan yet. They have agreed with the terms and conditions. That's it. And thereafter, simultaneously, you will sign the mortgage, and the receipt and everything can be signed on the same day. But the offer letter has to be signed prior to the mortgage bonds and all the other loan documents. Clear?
It should be prior, sir. If not, simultaneously, can you sign offer and
What
on the
has
same
happened
day?
is, yeah, I know that simultaneously you get them to sign, because that is the practice. You keep the offer letter ready. Once the customer comes in, then you sign all these documents. But ideally, the good customers will never sign all these documents unless they see the offer. So offer can be signed prior to that. Offer doesn't say that loan has been disbursed. They agree to disburse it on those conditions. But thereafter, they can sign the loan agreement, mortgages, and everything. And at that time only, you can disburse the loan even. Clear?
Okay. Thanks.
So this part of the presentation I discussed already, perfecting credit security documents, in the sense that getting the signatures duly, and also register notifying the third parties. These are the important third parties: register of companies, land registry, register of motor vehicles, insurance companies. Because if there is a security like the insurance policies, then you have to assign the insurance policy. So assignment has to be done prior to the disbursement of the loan. And if you go with the shares, then CDS is a very important place to do the documentation part. So this is the follow-up elements, and there are two things that you need to follow up. One is the compliance, and the second one is the performance. And I recently had a series of interviews with a kind of a program. In it, I found that some of the applicants in that particular program, they were working for companies who are doing the follow-up procedures, like the terms and conditions. Compliance is outsourced. Some of the international banks, even they work in Sri Lanka, they have outsourced the compliance procedure to some other companies. So they follow up all these terms and conditions. Even like a very simple one. If there is a term, a condition to the customer that you should channel 50% of your sales proceeds to this particular account. If it not happen, then these people will call up and make sure that it happens. That kind of a follow-up has to be done. And also the insurance matters need to be followed by. This is nothing to do with the credit admin department, but once there is somebody, basically the post disbursement and follow-up will be happened by the relationship managers. They are supposed to look at all these follow-ups, especially the compliances. And the performance, operating results. At the time of granting the loan, you agree with the customer, okay, every 3 months or once in 6 months, that once in a year, you have to submit the operating results and the financial results. Ideally, operating results coming from management accounts, the financial results are coming from the audited accounts. But in Sri Lanka, as a practice, what has happened is, for both cases, what they produce is the management accounts. And in case of a rehabilitation, of course, ideally you should look at stock reports, then again debtors reports, creditors reports, and other very operations reports and everything, ideally, but it doesn't happen. But at least financial statements, or rather income statement, balance sheet, and the cash flow should be submitted on an agreed frequency, and thereafter. So what do you look at from these operations? Because now, as far as IFRS 9 is concerned, or rather CFRS 9 is concerned, when the company is not making any profit over a period of time, you have to put that customer into the stage 2 based on the performance. So for that matter, and also financial information is an early warning signal for you to ensure that to make some decisions, because unless wait until the last moment, you can put some more conditions, or else you can call the customer, or else you can, if it is a revolving facility, you can stop the facility prematurely. So a lot of things can be done provided that you call for this financial statement. But unfortunately, in Sri Lanka, in most of the banks, you will call this financial statement only upon only when there is a requirement of a fresh loan back again. Otherwise, both parties are silent, so that you don't know what happens. So that's not a good practice. Monitoring loan repayment, of course, it happens because it is reported in your system, so that you can see the flags and coming down, and the loan repayment is delayed, so that you are worried, and then you call upon the customer and various things. CRIP report is a good indication whether the customer has borrowed from other banks, other financial institution, because supposing customer has agreed with you not to borrow, and then you can see from the CRIP report they have borrowed, because you should not let the customer to excessively borrow from other banks, because that will harm the leverage of the company, so that at a given point, when the customer is in trouble, when there is an excessive borrowing, he won't be able to repay your loan and their loan as well. Customer risk rating ideally has to be done once in every 6 months. So you know that when there are notches downgraded, couple of notches downgraded in the risk rating, either internal or external, so you have to degrade your customer. Risk rating has to go down. Okay, because if you keep the risk rating, if you price the loan according to the risk rating, and if the risk rating has gone down, of course you can change the pricing as well. And accounts behavior, you can see the behavior of the customer through deposits. You can see the behavior customer. You can see the behavior of the customer through loan repayment, how many days they take. You can see the behavior of the customer through settlement of the temporary facilities obtained. You can see the behavior of the customer from the CRIP report, or not the CRIP report, but margin accounts or build-ups, because they may have agreed with you, okay, I will build up, have a cash build-up monthly so much. So if that is not coming, so you can see the behavior of the customer from the accounts that are maintained with your bank. So there are the early warning signals, internal and external. From the site visits, you can see them, and from the accounts, you can see them. From the financial information they provide, you can see them. From the gossips lines, you can see them. From the suppliers, you can see them. From the buyers, you can see them. From the reputation, from the newspapers, there are various other methods that you can see the early warning signals. And that is why the bankers are supposed to read the newspapers every day and be in line with the other bankers to discuss in forums about various customers, because some customers have borrowed from various banks rather. So you better have a contact with the other bank officers nearby, so that you can know exactly what is going on, because these customers may not go to a far away branch, rather he will concentrate on the same town. So better suppose if you are working with HNB, better you have a link with the commercial and Bank of Ceylon and People's Bank, or even with the small banks like NTB Pan Asia, whether these customers are banking, or else you can see from the CRIB report whether they have borrowed from anywhere else. So those information are very, very important when you do the follow-up. Any other questions before I go for the securities? So that's going to be the final presentation for today and for the session itself. Yeah, a couple of slides are duplicated over here as well. Okay, let's try to finish it off and finish the session itself. You know, as far as the securities is concerned, the primary security of any loan is the cash flow. Nothing else, ideally. So if you take only the cash flow, you can go with clean basis. What do you mean by clean basis? You will accept only the application, loan out, receipt, and the loan agreement. That's it. No other securities at all, because you are sure of the cash flows. Most of the corporate banking happens like that. They are reluctant to give any corporate guarantees or the personal guarantees because their cash flow is very solid. Some of the companies are in the business for the last over 100 years, 150 years. When you try to ask securities, what they say is, what do you want? Like, I mean, that we are in the business for more than so many years. You don't believe us. So the brand itself is a very reputed one, and these companies will never go down overnight. And even if they go down, you can get to know in advance. So these companies will never give you any other securities. Okay. So these other securities are in two ways. Either indirect obligations or the direct obligations. Before that, yeah, other securities are either in indirect obligations or direct obligations. But when you say direct obligations, they are the collateral. Okay, they are the collateral. So collateral in the sense the properties that you see in securities. So there is another type of security which is the guarantees. There is a series of guarantees which I will explain you later. But why people are then asked for collateral? Because at every time that when you go in the cash flow, there is a serious problem of probability. It is not like a retail customer. If you take a retail customer, you know that if they work for John Cares, you are not worried about his securities because you know that the cash flow is steady. And this fellow who is going to be your client is not going to leave John Cares even. Where John Cares is one of the big companies and a good company, so they can't meet those kind of remuneration with the other similar companies. Like why every bank is like to lend to these government employees, because once they join with the employment, they will never leave the organization. That is why they are poor even. Why the government employees are poor? One thing is the government salaries are not that high. Even the big ranks, they don't draw up a big salary. That's the nature of the government salaries. But some people love to see that pension schemes are there. But with that, of course, what they do, they totally struggle over a period of time. Because what do they struggle like? I mean that they borrow the max that they can borrow from banks. The banks are there in the queues to lend them because the cash flow is good. Not the individuals, but the organization. So far, I don't know in future, but so far the government cash flows are good. That is what the perception. So when it comes to business, what has happened is you are not sure of the steady cash flow of a business because there's a saying in general, if it is a startup, 1 out of or rather 9 out of 10 will close within the first 5 years, simply because lack of experience and capital. This is a US statement, okay, not a Sri Lankan statement. And thereafter, within the next 5 years, the remaining one, if you take all these remaining ones, 1 out of 9 only will remain. That means 9 out of 10 again will collapse due to again 2 reasons. One reason is again the lack of capital. Number 2, not lack of experience, lack of energy. They are fed up. They are fed up of many reasons. So the presumption is that most of the private establishments or the business organization fail within the first 10 years. And if a company can pass the first 10 years, and there's a tendency that they will remain for a longer period of time unless they are not purposely close it down, because by the time they are matured enough, and of course a brand has been developed and the proper systems are developed. And remember, what is a business? Business has two elements basically. One is the system, the other one is the people. So business is all about establishing a set of systems and procedures, programs and all. It is not a product. Product, of course, part of the system. Okay. And these systems should be executed by the people who have been deployed there. So you have to worry about these two things when it comes to a business loan. Right. So there are chances over a period of time these cash flows might depreciate. So that is why always as a practice that our bankers would love to see the hard collateral, even in the case of getting the cash flows into a downstream, at least you have the comfort of security so that the customer will be encouraged to repay it and get the properties released. Now, I'm not going to read all these things, of course, that is not that 100% relevant. When it comes to large projects, of course, project financing security is totally different, because these large projects hardly any securities. Like if I take a classic example, the government projects like the toll roads, water projects, hydropowers, of course, even if they give us the whole mortgage of that property, you can't sell in an auction. If I take a simple example of now we have a twin towers now in port. Supposing if you have taken the mortgage of twin towers, if you are going to sell that in an auction, who is going to buy it? Some people will there to buy the floors of the twin towers, but not the entire two buildings. So likewise, when it comes to large projects, it's very difficult to take security. So that you have to primarily focus on the project cash flows. Okay. In it only we discuss two concepts like non-recourse lending and the limited recourse lending. Non-recourse is basically try to give it on the course of the strength of the cash flows, and limited recourse is basically you are trying to get some other properties. And there's another point which is called the full recourse. Full recourse is basically you get personal properties and other guarantees and government guarantees and everything, and ensure that fully secured, full recourse in the sense. But when it comes to project lending, which is basically unsecured, and you go by the non-recourse basis in most of the cases, where you try to believe in cash flows. If you take the legal perspectives of obtaining securities, this is what I was trying to tell you. And there are two aspects, direct and indirect. So direct securities are the properties, indirect securities are guarantees. If you take the guarantees, as usually you can see personal guarantees, corporate guarantees, promissory notes, and bank guarantees, central bank credit guarantees, letter of comfort, basically issued by a government organization. Government guarantees and indemnity. And indemnity is part of the any document nowadays. Nowadays, it is not going as an individual document. Indemnity is always as close in all the other 7 documents. Okay. Government guarantees will be issued only on behalf of the government companies, government organization, not for private sector. Therefore, individuals credit guarantee will come only with the central bank credit guarantee schemes right now. But recent times there is a discussion with the Ministry of Finance along with the other banks and with the support of ADB to establish a credit guarantee institution in Sri Lanka, which is yet to happen. But until such upon, of course, the central bank will take care of credit guarantees. Bank guarantees, of course, there are various bank guarantees, as you know, bid bonds, performance bonds, and then again money retention guarantees, shipping guarantees, bank guarantees itself, for agencies and all. Those guarantees are available. But when you go to the other side, properties, how do you take these properties? Because you can't take a property unless you get them to transfer in your name. But in banking, we don't take the absolute ownership except in 3 cases. Okay, except in 3 cases. One is in assignment, but it is not a hard property as per se, but it is an assignment like insurance policies. In insurance policy, assignment happens so that you don't have to go through a litigation process. Once the customer default, you can get the documents executed with the insurance company and get the money recovered. Number 2, trust. Trust, what happens is that the properties are owned by the bank. Okay, especially import trust receipts and all. Properties are owned by the banks, and we are not going to transfer the ownership to the customer unless the money is recovered. Of course, it is not transfer. It is just our goods are being sold by an agent. Our agent is our client. Okay, so supposing if he doesn't repay my loan, what do? I go to the police station and say these people have stolen my goods, so that they will come and take the people into the custody. So none of the any of the other cases, you can't take the customer into custody straight away without a legal hearing. But here in this case, trust is a breach of trust. We have a very important document because I have given my goods to the client on the basis of the trust that I have established. He has established with me. Okay, so once in a while that you should go and see whether your goods are there or not. If you feel the goods are not there, you have to tell the customer to repay your loan, or else return the goods, or else you have to tell the police station that he has stolen my goods. Number 3, agreements. So what are these agreements? The 2 examples are the lease agreements and the hire purchase agreements. What happens is, in a lease agreement, that leasing company owns the properties. So they give it to the customer on a rental basis, hiring basis or rental basis. So customer will keep on paying a rental, and the property is not owned by the customer. Only at the last point that they will transfer the ownership. Until such time, the properties are owned by the leasing companies. That is why there is a seizing system, so that there is a couple of set of people who will go and take the vehicle back again with a complaint lodged with the nearest police station. So that's a legal proceeding, and some people misunderstand. So during the pandemic, we could see that there were incidents where the people were trying to get the property back again on the strength of the president, but there is a legal proceeding. So even the central bank did not intervene with that. There were guidelines issued, but then again, if you look at the clarity of the legal, that is as such. And on the nominal ownership, where that we take a temporary ownership, how lien, charge, and set off. If you take very carefully, what is this lien? Give me a second. Give me 2 minutes to have some water and come back. Generally, the bankers have a general lien to keep a property which is given by the customer until the dues are settled. Even you can have the lien on a deposit account unless it is not properly designated to a particular payment. Okay, but today the bankers are very smart, so that they will take a letter of set off. Set off is the ideal way to take a right, have the right. This is combining of debt and credit accounts, so that to arrive at a partial or full repayment of a debt, the banker has the right to set off different accounts in the name of the same customer, provided that he or she has not agreed to keep them separate, or provided that the accounts are in the same right. It is not entirely certain that a bank has the right to set off balances without notice of the customer, especially where they are still on active running accounts. Therefore, it is common practice to take a letter of set-off from the customer to given such right. A letter of set-off is given by a limited company should be registered with the registrar company, so that it is a very clear direction. So, when a customer has given letter of set-off against the lien, general lien, okay. But in between, you find that charges, bandhaniya, to take a pledge or a mortgage or an assignment of security belong to the borrower. There are two ways of taking one. That is, one is fixed charge and a floating charge. Fixed charge is good for loans. Floating charge is good for. There are two aspects of. When the security is revolving, you can have a floating charge. When the loan is revolving, you can have a floating charge. But most popular one is basically the floating mortgages that we take for overdraft and all. So the pledge can be, there are four methods of taking a charge. Bandhane ganna krama hatarak thiyena. One is odapanel, the pledge. And there are two branches, general pledge and a special pledge. If I tell you what is an special pledge, our People's Bank pawning is coming under special pledge. Like, I think across the banking industry, the pawning is coming under a special pledge. It is an act. There is a pawning act. Okay. Because it is only for 1 year and there is a particular system. Otherwise, it is a general pledge. General pledge can be in two ways, positive pledge and the negative pledge. Under a positive pledge, the goods need to be kept along with the in the custody of the bank. So the bank might have their own stores. So the customer will bring the goods and put them into the bank's ownership. But what happens is practically we don't have stores, so that we will take the customer's stores on a lease agreement, and then customers' goods will be there, and we will padlock it. But there had been a lot of issues, so that we ask the customer also to padlock it, so that there won't be any complications, so that the both parties need to get together to reopen the pledge facility. Negative pledge is the opposite one, where we don't have the goods. So we ask the customer to have the goods in his custody and write a pledge document. So obviously, these type of pledges will be extended only for very healthy, high net worth customers, where you can believe them, and you have to take an undertaking that they will not pledge these goods for any other bank unless we have given them the concurrence. But even we don't give them the concurrence, because it is a negative pledge. In the sense, the difference between positive and negative is we don't believe the customer in positive pledges, so that they have to bring the goods and put in our custody. Whereas negative pledges, we 100% believe the customer, we will allow him to take it over. Mortgages are the most popular. We will take it up later. And hypothecation is another type of mortgage, which is for immovable properties, movable properties rather. Especially in the other part of the world, mortgages are good for immovable. Hypothecation is used for movables. Hypothecation is quite easier than the mortgages, because that is for vehicles and stocks and various other stuff. Charges on securities are used for government securities like treasury bills and bonds or shares, and that's a special documentation which happens, which is to take the nominal ownership of treasury bills and bonds. But remember, when you take these charges on securities, better to take a power of attorney also, in case that the customer is reluctant to sign some of the transfer documents, that you manager can sign on behalf of the customer. Mortgage is the most popular in Sri Lanka. There are two ways of taking illegal mortgage. An equitable mortgage we don't practice right now, where you don't you just bring a document and keep it with the manager and take the loan. There is no registration as such, but legal mortgage is the right method, where the legal officer will take the mortgages and register with the land registry and issue a letter to the branch manager saying that the mortgage has been executed, so that you can release the loan. There are types of mortgages which I am not going to explain each and every one, which is very lengthy. Primary mortgage, the secondary, third, fourth, and mortgages, of course, you call them push-in mortgages. Concurrent mortgages happened along with the what you call syndication loans. And sub-mortgages we don't practice. Special mortgages happens in certain cases, but supplementary mortgages, if you are not happy with one mortgage, you might ask for some other additional mortgages for supplementary mortgage. And there is another additional mortgage bond. Additional mortgage bond will be signed if there is a problem with the primary mortgage bond, error correction or something, that you will sign a additional mortgage bond. The other one is agreement relating to mortgage. Supposing if you lend a customer to bring down a machinery where you are going to take the mortgage on the same machinery, right at the moment you don't have the property, so that you agree with the customer to take the mortgage. So primarily you sign an agreement to mortgage with the customer. Once the machine come down here and do an inspection, you execute the right mortgage. So in case customer doesn't agree to sign the mortgage, so that you have to take a power of attorney, even this case also. You know that if you take a floating mortgage, once especially for an overdraft facility, for an example, once a year is completed, you can take acceptance of existing mortgage so that you can continue with that letter itself, because generally floating mortgages are valid for 10 years. So each year that you can take an acceptance letter, that's good. Otherwise you have to pay stamp duty and legal charges and everything. It is very costly for the customer, and a bank also doesn't get much of that. So better you do with the acceptance of existing mortgage. That will continue to exist for another 10 years. But remember, you can't do it unless if the rates and other conditions are changed. If the loan amount and the rates are changed, then you have to write a fresh mortgage. So these are the collateral that you can say. Couple of last slides. Project assets can be taken: land and building, plant and machinery, vehicles, insurance policies, stocks. Agreement, supply by agreement also can be taken as collateral in certain cases. Directors' guarantees, corporate guarantees, shares, government guarantees, letter of comfort. Offtake guarantees are the guarantees given by the buyer, like CEB guarantees and offtake guarantee. It is not a guarantee per se, it is an agreement. If there is a guarantee that the buyer will say that I will take care of this loan, then it is a offtake guarantee. What are the good characteristics? Yes.
Sir, there are two things to clarify. So one is the stock mortgages.
Yeah.
Can we use stock mortgages for revolving facilities? The other thing is the normal in the practice, we use mortgage leeways for several facilities. So is that valid, or this? Do you have to have a fresh mortgage for a fresh facilities other than POD or the revolving facility?
No, you can have the same mortgage. You can have one mortgage for several facilities, but you have to classify the facilities separately. Okay, the entire, you can't have combined securities, but you can have one security for combined facilities. I'll repeat that again. You can't have combined securities for one facility. Then you have to split the whole loan into separate loans in relation to the security.
Mortgage values.
Yeah, that's right. You can have a combined facility for one security. Only thing, those documents should be separately taken. So if it is a term loan, because the conditions are different. Okay, and then again,
if it is a term loan, if the term is for 5 years, so can you use the same bond for another facility for another 4 or 5 years?
You can, provided that you take the longer tenure, so that everything is covered with the same mortgage.
Yes.
Okay, then it is covered. Your second question.
Then this the fixed mortgages for stock mortgages, can we use those for revolving facilities?
No, you can't have one fixed and one mortgage. You can't have one mortgage for a term loan and a revolving facility. Then you have to have two mortgages, because one is a fixed mortgage, the other one is a revolving mortgage. or rather floating mortgage.
Yeah.
So it has to be separate mortgages.
Yeah.
It is a
No,
second
my question, sir, my question is, if you have a stock mortgage, the fixed stock mortgage, can you use that mortgage bond for revolving facilities?
Okay, I will very clearly classify it. It is a floating bond, floating mortgage for stocks. That means, okay, make it very clear. Hari, you have a revolving facility.
Yeah.
So within the revolving facility, you get the customer to revolve his facility within a corridor.
Yes.
Okay. For which purpose you have taken X amount of stocks.
Yes.
Let's say the stock amount is 10 million, where the facility is 5 million. Fair enough, no? Only 50% of the
Yeah.
stocks.
50%. Yes.
Then you have a floating mortgage. That floating mortgage is not for the revolving purpose, but for the stock purpose, collateral purpose. Collateral is revolving.
Yeah.
Then once you
Yeah.
take this kind of a mortgage, you have to be like a, what do you call, eagle, because
Yes.
the moment he defaults, you need to rush to the particular company and take a stock list and crystallize. There is something called crystallization. Okay. Thereafter, you can't execute the facility, you can't do anything, and you have to somehow or other get a stock list, and immediately thereafter you have to take the legal action, because you will take the legal action only on the amount of stocks available at that time. Number one. Number two, before that, every 6 months or every 3 months, you have to do inspection and see whether the stocks level of stocks is available, quality of the level, amount of stocks, and all the and the items, because you don't take the list of items into this mortgage, no, unlike in other cases, because you can't do it. It is just of course you take it, but you don't 100% verify it, and you don't recognize each and everything. Like if you have some water bottles in the stocks, of course you can't recognize each and every one separately. But you get the customer to issue a list of stocks, and then you go with that only. Okay.
Yes.
So you can see it is a very cumbersome way of taking mortgages. Therefore, if it is a mortgage, we don't I mean that we do take mortgages only for good customers. It is almost like a negative pledge. So, and the other thing is, that is why always when you take these immovable facilities, mortgages of stocks or mortgages of vehicles, we go along with 2 guarantors to avoid that risk. Otherwise, you don't have to take guarantors. Why we take guarantors? We are not sure of the level of stocks and the quality of the stocks, and we can't monitor as in the other cases.
If a partnership, sir, can we take the partners as the guarantors for such facilities?
Not at all.
It's not, no point, no?
No, you can't. Legally, you can't, because the partners are the loan applicants. The loan applicant cannot be a guarantor. So you have to take somebody else, a third party. Guarantor is the one who comes and tell you, if the partners are not going to pay you, I will pay. How do you take partners as guarantors then?
Yeah, that's
clear.
Okay, sir. Thank you.
So the good characteristics. So these are the characteristics. From there also you can understand. Should be easily identified. Now, if you take the stocks, it is very difficult to identify. It is not a good security then. Valuation. You should be able to value it, not the cost of it. Now if you take a water bottle, I have a brand new water bottle over here with me. I don't know whether you can see this one. Now this is not opened even. This particular bottle, if I ask you the value, you will not tell me the value. But if I ask you the cost, you might jump and tell me it is 35 rupees. But if you take the value of this bottle, it is almost zero, because I can't realize this value 35 rupees, because as a person who is working for IBSL, I can't take this, I can't drop this bottle and go to the market and sell this one. It's not practically possible. So there is no value in it, but there's a cost in it. Likewise, if you take a security as a mortgage, then you have to look at the value of it, not the cost of it. Now, for an example, there can be lands where the same land will be valued for commercial purpose. You will get a separate value, and mortgage purpose, it's a different value. Why it is a different value? The valuers will value the property at arm's length distance because it's foreseeable value. In case that if you are to auction the property, that you have to force it and auction it. The customer won't like it. So obviously, what happens is that the value of the property as you see may not be reflected for the purpose of taking mortgages. So there is always fight between the customer and the bank. They say, no, this is not the real value, you are discounted. So it is purposely discounted for the purpose of taking mortgages. You have to explain the customer about that. And absolutely it has to be a durable value, but even if you take the debtors as mortgages or the stocks as mortgages, you don't see that kind of a durability. Title has to be clear. And if the title is not clear, of course, I have seen that the legal officers may ask you to take a insurance, title insurance, and take it. Ideally, the value should be appreciated. That is why every banker like to land and building and vehicles. Even in Sri Lankan context, the vehicles have been appreciated. They shouldn't have any contingent liabilities, and even if there is a occupant in the land who is on a rent basis, that you might ask for a deed of postponement, that they should agree to leave as the bank wants. There should be any legal barriers. Should be easily mortgaged to the bank. Cost of the mortgage should be less, and owner should have an interest on the security. What does that mean? And I have seen some of the customers bring down some jungles for mortgage purpose. And land but that itself shows us that they don't have any interest on the land. That Chicago, the purpose of obtaining the loan only, they bring a security. And easy administration, pledges are very much cumbersome and should be. So the last point is the one that you should look at always. One other thing which is not over here, access to the property. Ideally, you are looking at 10 feet road, of course. It is not 10 feet or 20 feet or 50 road. Whatever it is, of course, you should be clearly reach there legally, and at least 10 feet is quite okay. And I have seen lands in Colombo area there, you can't take a vehicle, but there's a value in it because there are buyers enough. So as long as you can easily realizable there is a value in it, of course you can accept it with the concurrence of the legal officers. I think all the others are supplementary slides to the explanation that I have already given. Yeah, it has been repeated with the other previous presentation. Right, so that comes to the end of my presentations. Are there any questions, by the way? Okay, if you do have any questions, you can email me. My email address is Narayana, Narayana, at peoplesbank.lk. peoplesbank.lk. Even if you go to our site, of course, you can see that. Narayana at peoplesbank.lk. Ideally, you can email me or else you can call me. My number is not 70 3624 822. Not 70 3624 822. I can take any call and email provided that I'm free, and even sometimes I may miss your calls, but ideally after 7-6, of course, I can answer your calls. No question of calling me, and you will have an exam paper with some simple questions, and try to answer from all the sections that I have covered here. There will be a case study where you may have to do some calculations like the ratio analysis and come up with I will try to ask you a question on the credit principles, capacity, right, character, capacity, and capital, which is the leverage, and SWOT analysis conditions, and the collateral securities. That would be my main question, and coupled with some other couple of questions. And those questions will be more practical oriented rather than theoretical, because this course is basically a practical course rather than a theoretical based one. I'm sorry, I'm not sure whether I could able to elaborate all what I had. If you were with me in the class, I could have done a lot of other case studies and small exercises. But during online presentation, it is quite difficult. I am not used to do it, even with because of this institute request only. I usually do, otherwise I don't do. So your exam will be on physical basis, I believe. You may have to come down here, or else, yeah, that is how we conduct exams. Any other questions?
When are you going to have the exam, sir?
Sorry?
When is the exam date? Like,
Give me a second. There are 2 more modules to be followed. So thereafter only your exams will be held, it seems. It will take about 2 months' time.
Thank you.
Hope there are no other questions. Of course, you give me a second. In addition to the exam, there will be a small project that you need to. It is not a project, of course, it is a case analysis. I will give you a case. You need to analyze and submit it. It's an actual case. So that will be uploaded to you within another couple of days' time, which will carry 10 marks, it seems. So you have the exam component and the assignment component.
So there's a project report also, no? Is it?
That is what you call the project like.
Okay.
In my course, of course, hardly it is not a project per se, but it is a case will be given to you that you have to analyze it and present it. Not viva like it is a hard copy.
All right, sir. So how can we get the past papers?
I will ask Menago to upload them.
Thank you, sir. Thank you very much.
Okay. Anything else? Of course, I do welcome any other questions, practical questions, wherever you are, no problem. Because I am a person who is working with the industry. So no question at all. You can ask me at any given point.
so when they upload the past papers, it's better we can get some, model answers also to see how the things are structured, and if possible.
I will try it because I am handling more papers, like even in 2 universities and here as well, because in universities, obviously you have to have a model answer. In other cases as well, but in these small courses, we don't do it. But I will try to do something for you, at least for the last paper.
Thank you.
Yes, sir. That will be very helpful, sir.
Yeah, I understand.
There's another opinion, but used
Sorry?
to sort from you. Now this RMB these days they don't do one-day transfers for the normal transfers or the people who are going there to do individual transfers. If that is coming through the through a financial institution or the bank, they will do it. Now this
Yeah.
most of the cases what we get is the vehicles are owned by third parties, and sometimes they are having the car sales people are having. So the disbursing facilities will be a problem because we are supposed to release the payments to the current owner of the vehicle. So what is the best advice you can give us for that matter, sir?
Okay, it's a contemporary issue. Like it is on open papers, I believe.
Yeah.
Of course, personally, I don't give a vehicle to a person because there's a risk of hit and run, even in some cases, if it is not registered with the particular present owner. I have to think and let you know exact answer because it is a contemporary issue. You
But
can email me, then I will discuss with our legal officers and let you know. I haven't got an answer
okay.
yet. In the sense, right now I don't have that answer, frankly speaking.
Because there are very common cases like when we are approving authorities, sometimes branches are asking us to give some directions, but we also can't give such directions because the technical matters we are not authorized to give directions. Only for the credit evaluation or the approval we can do. But those kind of technical things, actually, we also can't give proper, guidance or the solution.
No, actually, frankly, it is not possible because the bank's responsibility is to disburse the money to the current owner. So owner is
Yeah.
the one who is the person who has given it to the broker. So the broker
Yeah.
is not the current owner. Legally, he is not the owner.
Yes. Broker or the car sale person.
Yeah,
They are not
and
the owners of the vehicle.
yeah, you can't make that payment to the owner because the broker has a margin on that. So the owner will
Yeah.
get to know the margin also when you release the payment to the actual owner.
Sometimes they can't, like, the car sale people can't locate the owners because maybe they may have purchased some time back, and there's no connection thereafter. Like, those are the practical problems. Most of the vehicles are still, like, we see on open papers,
Okay,
and also
only
we
way
get.
I will tell you.
Yeah.
I'll tell you a solution. I don't know whether it is possible or not. Of course, you can create a facility. You can create a facility on a immovable property mortgage. So you have a separate security for that facility. So within the context of facility, you can look at the purpose and release money to the broker. So the broker should have a credit line with the mortgage, with something else.
Mm.
Then
Mm.
you can do, no matter who is the owner, because obviously this is a current contemporary practice which is happening right now because of this curtailment of imports. Earlier we
Yes.
didn't have that. Otherwise, technically you can't advise. Even if you go to the motor vehicle register, what they say is don't sign the open papers here, and again that is how they instruct us.
Yes.
So given that, so you are encouraging illegal things.
Mm.
That's not possible. So unless you come up with a structured facility on a separate mortgage. We have done like that, of course. That is why we haven't got this issue yet.
Mm.
So can you kindly repeat your email address, please?
Narayana, N-A-R-A, NARAYANA People's Bank, one word, simple letters. PEO, PLES, PANK, no apostrophes between, and .lk.
Hello.
Yes.
So
Yes.
actually, this is something related to the market at prevailing situation.
Yes.
So it's look like the industry is more advising the financial institutes to apply a value driven credit culture, since the market prices are but if you take an example, now if we take banks used to advance 90% from BOQ when if it is housing loan, likewise vehicle 70%, but the BOQs are being prepared with the market prices, but the 90% value after the construction, the 90% value will not be generated through the construction. So if the banks are to sell the property, that 90% will not be there. So unless with the if the only the bank only have the property value. So in that case, I think it's better to have more, the industry should go for a value driven culture. But we see when one bank is applying a value driven culture, sometimes another will go after profits, and they might go with the present valuation. And don't you think that this is do we have to have a common agreement with the at least main banks? This
It's a very good question. The question within the question you have the answer, because from the history, even in 2008 collapse, what happened was there were two segments of prime customers and subprime customers, and more largely the subprime customers were entertained by large amount of banks, and they did not go after the employment details, and they did not go after the asset values, and anybody could borrow from any bank, and the banks were going after the customers. No matter what you do, of course, they were promoting loans, and the marketing fellows were rich at that time, and they were given a lot of promotions and what you call remuneration packages. And this is the cause of the problem happened in 2008, because while that was practiced, and then the market were collapsed in the sense there was an economic crisis, and then the land price came down, and the bank could not sell them in the auctions, and the value of the properties came down, so that the banks had basically, and by the time they had some securitization, so the bank had pooled those assets into a packet and given to some other SPVs, so that borrowed money from them as bonds, and they utilized those monies, and all that were defaulted as a result of the liquidity crunch that they had at that time. So you are asking the same thing, and which might happen, especially during a recession. The fundamentally what you need to do is the value driven cultures. All the banks, not only one bank, every bank should do it, of course. And it is default, I mean, that whether you have market driven cultures or the profit share driven cultures, the value driven culture is the one that I advise, because they are brilliant in basics. So when you follow the basics, you will generally don't collapse in a crisis, of course. And when the economy is doing good, but these value driven cultures may not be so profitable, because the market share driven and the profit share driven people are very aggressive. They go after the risk and do the lending, that they may take profit. But during a recession, the one who does follow the principles only can survive. Obviously, right at this moment, what you need to do is the value driven culture. Number one, answer to your question. Number two, when it comes to valuation of properties, obviously you need to have a proper kind of a, what do you call, a very comprehensive discount method. And your credit committee and the valuation committee should decide, okay, what is our for sale value, and out of which what is the loan to value ratio that you apply. Now in my bank, of course, we take 60%. That is the default rate. But if someone, it doesn't mean that we will stick only with the 60%, but there are cases where that we go with 80%, 90%, even with over 100%. That is specific basis, not a general basis. So there can be customers who will go for 80%. In that case, it is exceeding the particular credit level authority, so that we will put it in the next level and justify why we go for 80%. So then you apply the other principles of credit. Number one, his character. Number two, his relationship. Number three, his repayment capacity. More than anything, I am happy with his cash flow. Okay. And he is not a default at all. So during this time that we should support him. And also I see, even though it is 80% of the property, and I will come up with a proper disbursement plan to ensure that the money which is disbursed to the entire property will be in good terms. I'll tell you a classic example. We did a big project, and the project value was about 6 billion at that time. We funded 3.5 billion into that project. But today the value is more than 10 billion, and remarkable value created as a result of the entire property development per se. But thanks God that it happened prior to the COVID period. If it happened during the COVID period, there would have been a cost overrun as well, because there are stoppages and work problems and everything, and the inflation also associated with that would have been obviously increased. So, but especially with the project, once the project is completed, there is a value which is created more than the monetary value, what you see. For an example, I myself built a house for a certain amount of money. I know 100% with that money that I can rebuild the house. I always used to look at the valuation reports which are happening right now. What I see is, even for these useless buildings, they value square feet like 6,000 rupees, 7,000 rupees. But we don't accept that. We don't accept it. What we do is, we just look at the pictures, and we just look at the location. We just look at the nature of the building, and we discount it and accept it as the wholesale value, out of which that only that we go standalone. Standard ratio is 60%, but there are cases where that we exceed 70, 80, 90 even, based on the other reasons. Plus, then you can come up with some more additional covenants to secure or rather mitigate the risk of lending. So over and over, it is all basic credit principles, nothing else. Don't be panic at any economic or environmental conditions. What you need to apply is the basic principles and pressure on them. And don't look at the other banks. Let them do whatever they want. Okay, let them do whatever they want. During the history of the banking industry, what I experienced with my over 26 years of experience, I believe, yeah, when you practice good, you can survive. But if you apply these aggressive ways of lending and unauthorized ways of lending, of course there are chances that you will go down. It was a very good question.
Thank you, sir.
Okay, looks no other questions. Okay, then let me say goodbye. Thank you so much for being with me. I could see that every day at least 20 odd people were with me. If I get a chance, of course, I will try to personally meet with you in the course of the period. I will ask Menaka also to have a meeting with you to mainly address if you have any issues further, because online you can't do it everything. And I also asked Menaka to upload some of the question papers and also the assignment guidelines. Okay, then all the best in your exam. If anything else, you can email, or else either you can call me. Thank you.
Yeah, sir, thank you very much, sir. It was a very fruitful time that we spent with you. More than the exams, there are many practical things we have discussed, and we actually acquired better knowledge on the things that we are doing day to day. Thank you very much, sir. We also love to see you. Please arrange the meeting, so we'll come and meet you there.
Yeah, definitely.
Thank you, sir.
Okay,
Thank you very much, sir. It was a very encouraging and very interactive session. Thanks a lot, sir. And I really agree with the gentleman who spoke just now. I also have the same sentiments to say. Appreciate it, sir. Thank you very much.
Appreciate. Thank you very much. Thank you.